Hi, I'm Joel Shapiro. I teach financial statement analysis at the Goodman Institute of Investment Management, which is part of the John Molson School of Business at Concordia University in Montreal. I also teach accounting, which includes many similar subjects, to undergraduates at Ryerson University in Toronto, which is where I live. Today's first session is about business combinations and mergers and acquisitions, and we'll follow that one up with talk about multinational operations and the translation of foreign currencies. But first, business combinations. There are two kinds, poolings and purchases. Nowadays, in Canada and in the United States, poolings are no longer allowed. They were previously, though. Only purchases are allowed now. But since many existing companies were formed originally with poolings, it's incumbent upon analysts to be able to understand how that was done so that those financial statements can be compared with others which are being created nowadays using the purchase method. And in other countries, in other parts of the world, poolings are still permitted. So it does help to understand both of them. Purchases first, since that's the one that's most common in today's business environment. In a purchase, one company is always considered the acquirer of the other company. They don't have to be the same size, not even close, but there's always one company that can be said to be buying the other. And on the balance sheet, what happens is that that company adds its share of the fair value of the net assets acquired to its own. They don't have to be buying the entire other company. They don't have to be, it doesn't matter whether they're buying it with cash or with its own shares. It makes no difference. All you have to do is take the fair value of the net assets that are being bought, and the parent company will now add it to its own. On the income statement, it's a little bit different. In a purchase, one company is always going to be considered the acquirer of another. One company is always doing the buying, and the other is being bought. The two companies don't have to be the same size. Not nearly. One company can be many orders of magnitude bigger than another. Another thing is that on the balance sheets, the acquirer, what they do is they add its share of the fair value of the net assets they're acquiring to its own. Net assets being assets and liabilities, and only its share and the fair value, not the book value. This is important. So, on the balance sheet, the fair value of the assets being acquired are added to the net assets of the purchaser. On the income statement, it's a little bit different. The income of the acquired company is included in the consolidated income prospectively. In other words, from the date of purchase on. This is a major difference between purchase and pooling, whereas a purchase is always accounted for only prospectively, starting from the date of purchase. This causes analysts a few headaches when an acquisition is being made in the middle of the year, of course, because now you have a discontinuity in the financial records of the consolidated group because the subsidiary is only added in from the date of purchase on. A pooling of interests, on the other hand, is accounted for as a merger of equals. There's no acquirer necessarily. Usually the companies in a pooling of interest are approximately the same size. Usually this will be effected through a share exchange rather than a cash purchase. If there is a cash purchase, then generally speaking, the company paying the cash would be considered the acquirer. In a pooling, as I mentioned, the companies are usually the same size. This doesn't necessarily have to be the case. I know of one case, one of the last poolings that was ever approved as such in Canada had three companies each being about the same size, and the fourth one turned out to be about a tenth the size of each of the others. So they ended up getting about 32, 32, 32, and 4% of the merged company individually. But that's an exception rather than a rule. A merger of equals is how you should consider a pooling. Now we'll show you just some comparatives between the two methods. In a purchase, the owner's equity on the consolidated balance sheet is the parent company's only. The subs gets eliminated upon consolidation. In a pooling, the owner's equity is the sum of both companies. There's no elimination at all. They just add the two together. The retained earnings, the common stock, and everything from the subsidiary company gets carried forward, and the two companies are combined as if they always had existed in a combined fashion. Another way of looking at it is a pooling is always done retroactively, and a purchase is always done prospectively. Okay, so the owner's equity, only the parent companies, gets carried forward. Here's another difference between purchase and pooling on the consolidated net assets, how they come out. With a purchase, the consolidated net assets are those of the parent originally, plus, as I mentioned, their percentage share of the fair value of the sub's net assets. In a pooling, again, the arithmetic's a lot easier. Just add both companies together. There is no fair value increments to worry about. You don't have to worry about market values or anything. You combine the two companies as if they were always combined right from day one. Here, on the purchase side, the percent share, that's the parent's percentage share, whatever they bought, it doesn't have to be 100%, of the fair value of the sub's net assets. The portion of the fair value that they didn't buy is not included at all, as we'll see in just a second. There are two items that you will see on consolidated balance sheets under the purchase method that you won't see under pooling at all, and that is minority interest and goodwill. Minority interest is the non-controlling shareholder's share of the book value of the sub. Not the fair value increments, they aren't counted there. And the minority interest is shown on the consolidated statements in the so-called mezzanine section. It's not part of liabilities. It's not part of equities. It's in between, and analysts sometimes consider them as liabilities, sometimes as equity. There's no real consistency there. The minority interest does, however, go up and down like an equity investment account with the minority share of the sub's net income and down by the minority share of the sub's dividends. You don't have any minority interest in a pooling at all. As far as goodwill is concerned, if the price paid is greater than the parent company's share of fair value, then we have goodwill. That doesn't happen under pooling either. In fact, the definition of goodwill is the excess of the price paid over your share of the fair value of the net assets acquired. Now here's a quick numerical example of how a consolidation is done. So get a pencil and a piece of paper handy. I'm going to give you some information and see if you can work out what the consolidated financial statements are going to be. In this example, let's assume that the sub has net assets of $100 and the fair value of those assets are $110. It really doesn't matter for the purpose of this example where the extra $10 comes from. It could be on intangibles, it could be on property, plant, and equipment, inventory, receivables, or even liabilities, which is a little rarer, but it's possible. Let's also assume that the parent's net assets are $500. It's easy to see who's the parent and who's the subsidiary because they're so different in size. And final assumption, let's assume that the parent is buying 80% of the sub and is paying $95 for it, okay? So we're going to have some minority interest, a 20% share, and we are probably going to have some goodwill as well because 80% of the fair value is $88 and the parent is paying more than that for it. So you can probably work out already that there's going to be $7 worth of goodwill by the time all is said and done. Let's go through the example in detail and we'll see how we do the entire consolidation. The parent's $500 is going to be consolidated. The sub's $100 of assets are going to be consolidated, plus $8 for the parent's share of the fair value increment. Remember, the fair value was $110. The book value of the sub was $100. Okay, the difference is 10, but the parent company only gets to count their 8. And assuming this was a cash purchase, we're going to take the $95 cash that they actually paid off the $500 originally as part of the parent's assets. This is out of the consolidated group now because the $95, remember, is going to go to the sub's individual shareholders, not to the sub. So our final number, $513.